Hello everyone, welcome to the weekly lecture videos once again. This is the last video of this chapter, and I'll be talking about share repurchases in this video. Thus far in this chapter, we have considered cash dividends. However, cash dividends are not the only way corporations distribute cash. Instead, a company can repurchase its own share subject to the Australian Securities and Investment Commission rules. Repurchases, or this is also called buybacks, have been an increasingly popular tool, and the amount spent on repurchase has become large. Okay. So share repurchase are typically accomplished in one of three ways. Okay, so first one, companies may simply purchase their own share just as anyone would buy the shares on the market. So in this open market purchase, the firm does not reveal itself as a buyer. Okay, so the seller does not know whether the shares were sold back to the firm or just to another investor. Okay, so the company buys the share from the open market like any other investor. So that's called the open market approach of buying shares back. The second one is tender offer. Here, the firm announces to all of its shareholders that it is willing to buy a fixed number of shares at a specific price. Okay. For example, suppose Arts and Craft Limited has 1 million share outstanding with a price of $5 per share. The firm makes a tender offer to buy 300,000 shares at $6 per share. Okay, so the company chooses a price above $5 to induce shareholders to sell. So that is the tender. Okay, so it's a tender their shares. In fact, if the tender price is set high enough, shareholders may very well want to sell more than 300,000 shares. In the extreme case where all outstanding shares are tendered, the company will buy back 3 out of every 10 shares that a shareholder has. Okay, and finally, firm may repurchase share from a specific individual shareholders. So this process has been called a targeted repurchase. Okay, targeted repurchase. For example, suppose the International Biotechnology Corporation purchased approximately 5% of the outstanding shares in Prime Robotics Company. Okay, in April at around $38 per share. Some real world consideration in a repurchase. Look, we learned about cash dividends in earlier videos, and we are talking about repurchases in this video. A repurchase and a cash dividend are the same thing in a world without taxes and transaction costs, right? In the real world, there are some accounting differences between a share repurchase and a cash dividend, but the most important difference is in the tax treatment. Okay, so under current tax law, a repurchase or a buyback has a significant tax effect that must be considered by the shareholder over a cash dividend. A dividend in a dividend imputation system can be effectively tax-free, depending on shareholders' marginal tax rate, but the shareholders has no choice about whether or not to receive the dividend. In a repurchase, a shareholder pays tax only if the shareholders actually chooses to sell and the company has structured the buyback to be tax effective for the shareholder. So it is common today that part of the buyback will be treated as dividends with franking credits attached, and part will be treated as capital gain on sale. Okay. However, it is justified. Some corporations have engaged in large repurchases in recent years, but this was prior to the global financial crisis. After the events of 2008, the global financial crisis, many companies has decided to build equity rather than its buyback. However, since February 2015, some companies in Australia have made sizable buyback decisions. So these are the points I just mentioned. Share repurchase and EPS. You may have read in the popular financial newspaper or business news that a share repurchase is beneficial because earning per share increases. Okay, because you understand that as company repurchase its own share from the market, so number of shares will decrease. As a result, if company continues to have similar earning, then the EPS will go up. Okay. There is a big example in the textbook, so I suggest that you manage some time to go through this example to understand this. The reason simply is that share repurchase reduces the number of share outstanding. Okay, so as I am talking about, the EPS rises, however, you need to understand the point that it doesn't have any real effect on the total earning, because if company continues to earn the same, still the EPS will go up without changing the actual earning. However, the financial price may place undue emphasis on EPS figure in a repurchase agreement. Okay, so we can see that the value of the shares is not affected by the EPS change because the earning has not changed. In fact, the price earning ratio will also remain exactly the same when we compare cash dividend with a repurchase. Okay, since the increase in earning per share is exactly tracked by the increase in price per share, there is no net effect. Okay, you understand that when a company repurchases, the number of share decreases. As a result, the earning per share increases. But if you talk about price earning ratio, okay, the price divided by earning, so earning increases. If price also captures these changes, then the price earning ratio will remain the same. Okay, so put another way, the increase in earning per share is just an accounting adjustment that reflects a change in the number of share outstanding, so it doesn't have any real effect on the company's operations and earnings. Okay. Now we will talk about few points to cover what we know so far and do not know about dividend and payout policies. Corporations typically smooth dividends. What we mean by that is dividend cuts are frequently viewed as very bad news by market participants. As a result, companies only cut dividends when there is no other acceptable alternative. For the same reason, companies are also reluctant to increase dividends unless they are sure the new dividend level can be sustained. Okay, so in practice, what we observe is that dividend-paying companies tend to raise dividends only after earnings have risen, and they do not increase or cut dividends in response to temporary earning fluctuations. In other words, dividend growth lags earnings growth, and dividend growth will tend to be much smoother than earning growth. Okay, I repeat, dividend growth lags earning growth. That means there should be earning growth first, followed by a dividend growth. And dividend growth tend to be much smoother than earning growth, because temporary fluctuation in earning will not lead to a dividend growth. Only if there is a sustained increase in earnings, the companies may tend to increase dividends. So if we put all together, much of what we have discussed so far can be put together as aggregate dividends and share repurchases are massive, and they have increased steadily in nominal and real terms over the years. Dividends are concentrated among a number of large mature firms, Managers are very reluctant to cut dividends, normally doing so only due to firm-specific problems. And managers smooth dividends, raising them slowly and incrementally as earnings grow. And share prices react to unanticipated changes in dividends. Okay. The challenge now is to fit these 5 pieces into reasonably coherent pictures. With regard to the payouts in general, meaning the combination of share repurchase and cash dividend, a simple life cycle theory fits 1 and 2. The key ideas are straightforward. First, relatively young and less profitable firms generally should not make cash distribution. They need the cash to fund investments. Okay. However, as a firm matures, it begins to generate cash flow, and significant free cash flow can lead to agency problem if it is not distributed. And managers may become tempted to pursue empire building or otherwise spend the excess cash in ways not in the shareholders' best interests. Thus, firms come under pressure to make distributions rather than hold cash. And consistent with what we observe, we expect large firms with a history of profitability to make large distribution. Thus, the life cycle theory says that firms trade off the agency cost of excess cash retention against the potential future cost of external equity financing. A firm should begin making distribution when it generates sufficient internal cash flow to fund its investment needs now and into foreseeable future. The more complex issue concerns the type of distribution, cash dividends versus repurchase. The tax argument clouds the issue, as we have seen. Some shareholders may favor repurchase, others opt for fully franked dividends. Repurchase are a much more flexible option and can be structured in such a way as to provide franking credits to shareholders. Okay. So the question is, why would firms ever choose a cash dividends? If we are to answer this question, we have to ask a different question. What can a cash dividend accomplish that a share repurchase cannot? One answer is that when a firm makes a commitment to pay a cash dividend now and into the future, it sends 2-part signal to the market. Okay, as one we have discussed, one signal is that firm anticipates being profitable with the ability to make the payments on an ongoing basis. Okay. Note that a firm cannot benefit by trying to fool the market in this regard, because the firm would ultimately be punished when it could not make the dividend payment. Thus, a cash dividend may let a firm distinguish itself from less profitable rivals. A second and more subtle signal takes us back to the agency problem of free cash flow. By committing to pay cash dividends now and in the future, the firm signals that it will not be holding cash, thereby reducing agency costs and enhancing shareholders' wealth. This 2-part signaling story is consistent with points 3 and 5, but an obvious objection remains. Why do not firms just commit to a policy of setting aside whatever money would be used to pay dividends and use it instead to buy back shares? After all, either way, a firm is committing to pay out cash to shareholders. A fixed repurchase strategy suffers from 2 drawbacks. The first is verifiability. A firm could announce an open market repurchase and then simply not do it. By suitably fudging its books, it would be some time before the deception was discovered. Thus, it would be necessary for shareholders to develop a monitoring mechanism, meaning some sort of way for shareholders to know for sure that the repurchase was in fact done. Okay, and such a mechanism would not be difficult to build, but it currently does not exist. Okay, and the second objection to a fixed repurchase strategy is more controversial. Suppose managers as insiders are better able than shareholders to judge whether their share price is too high or too low. In this case, a fixed repurchase commitment forces management to buy back shares even in circumstances when the share is overvalued. In other words, it forces management into making negative NPV investments. So that's essentially the end of our discussion on stock repurchase and a discussion on reconciling dividend and repurchase decision. Thank you very much.